terms of inviting a tax person to talk about tax is the most dangerous thing you can do because we love to get technical. We like commas, full stops, and that's what we live on. What we've tried to do in the slides is to try and take it away from that and talk more about the big picture, try and spend some time on the whole economic perspective of GST, try and spend some time on 2 or 3 big changes that are coming in, talk about a few highlights of how our businesses are getting impacted both as funds and as distributors, and then if time permits, with a 24.59 minute crunch that I have, if time permits, we'll take some questions on if at all there are any sectors that you would like us to share what we've already seen as perspective, challenges, and how some of these sectors are preparing for the change. So the GST story is a big economic story. There are several aspects to why GST is so necessary for our country, and there's a big discussion that we've been having that GST has the potential to drive economic growth, to push GDP, and there is a lot of credibility to that story. Starting with the fact that today a lot of sectors are driven by how tax applies, and they've designed their supply chains based on tax. They've set up warehouses, for example, in most states and union territories to ensure they don't pay central sales tax. It clearly brings in a lot of inefficiency in the way they supply and distribute products, but because empirically the cost of setting up a warehouse in a state is not more than 1% of the inventory, and CST is 2%, you have a natural advantage of setting up a warehouse and trying to save that tax. So likewise, there are several and more examples that you will see more in the manufacturing and trading sector of how supply chains or businesses or manufacturing for that matter, there are so many manufacturers based out of Baddi, and these are obviously sitting there not because it's the best infrastructural place, but because there was an excise holiday that operated for investment till 2010, holiday expires 2020. So why force businesses to design themselves based on tax? Or the other question is, why give advantage to certain businesses who have designed it in a particular manner versus somebody who hasn't? If you are in Baddi, you have a 12.5% advantage over somebody who's not in Baddi. And that creates distortion, that creates competitive disadvantage. And why should tax be a factor in that? The funniest example that I always share, which I've learned in the process, is, and I think all of us, if we are from Mumbai, we've experienced this, that construction of flyovers in our city has taken always forever. And we always blame because contractors love to do everything on site. They block everything, 5 years, one flyover. So other than the Bandra flyover, I think we've seen at least 4 to 5 years for any construction, right? So one of the big reasons for that is actually tax, okay? And the reason is that in tax or in excise duty, to be specific, if you create preforms and then move them and bring it to site, preforms are liable to 12.5% excise duty. But there is an exemption for construction at site. Now, if I'm a contractor, I've always cut corners, built a tax-inclusive price, and bid and won on an L1 basis, most probably. Obviously, if I get the opportunity to save 12.5% excise duty on my biggest item, which is preforms, I would love to construct at site. So this is how indirect tax influences a lot of supply chain decisions, creates inefficiencies, and therefore is not desirable. GST is targeted to address that. So that's a strong case in point of why we need GST, why we think it's going to result in better application of factors of production, why we think there's a big GDP story here, because obviously if you have more bang for the buck if you have lesser inefficiencies, if you get full tax credits of what tax costs you incur, your ability to get more ROE increases, and therefore you have better results. Now, how is it being brought in? So right now, I would say this is step one. This is not the end of the line. In step one, we are merging three major taxes, which is service tax, excise, and VAT. We are also merging a host of other smaller taxes, namely luxury tax. So now you stay in a hotel, you will get tax credits for the taxes that you pay, or entertainment tax, and therefore it significantly benefits the entertainment sector. Betting and gambling tax, which is more personal entertainment, so no difference there. Entry tax, octroi. So more than 22 odd taxes are merging into GST. It's going to be a dual levy where the center and the state come together to levy the tax. Those are semantics. I'm not getting into the semantics at all, trying to stay away from them. When we talk about the issues for the MF sector, we will talk about how these semantics are specifically impacting. So from a framework standpoint, the only key aspect that we need to understand is that state becomes a joint stakeholder in every transaction in the economy. Whatever transaction occurs, both center and state levy tax. And therefore, a question that is a very, very important technical question, as well as a big practical challenge for businesses is, which state do I pay the tax? I have 36 states and union territories. I don't usually define my business in a manner that I do everything within one state. And therefore, which state do I pay the tax? Let's take a very simple example. We're all customers of a telecom company based out of Mumbai, but we travel a lot, right? So for your 3 days of visit to Delhi, where does Vodafone pay tax? Does it pay tax because you are in Delhi and you consume roaming in Delhi? Does it pay tax in Mumbai because you are a Mumbai customer, or Vodafone is billing out of Mumbai? So the question of which state becomes very important when you divide the taxing jurisdictions into state level units. Closer to home, your distributors will be, in a sense, tied to certain branches and being managed by people at the branch. So now when they bill you for their commissions, or you pay them including service tax, if you have to recover tax credits of what they are paying on their commissions, then will they bill your Jaipur office, or will they bill your Mumbai office if it's a Rajasthan distributor? So the question of which state is one of the biggest questions that needs to be answered, especially for service providers. For goods, this has been a very old question. Manufacturers and traders have been used to this question. They have figured it out, and they know, how this logic works. For services, it is a significant challenge because I can keep complicating examples, and it to an extent sometimes gets very humorous to decide which state. So I'm working with this example for a client where there is a life insurance product that has been sold by a salesperson in Cochin who reports into a regional manager in Bangalore, and therefore the regional manager of Bangalore is driving the sales strategy. The underwriter of that organization is sitting in Delhi. The policy is centrally issued from a central processing unit in Mumbai. The head office of that company is in Gurgaon, right? And for stamp duty purposes, I'm paying tax in the 7th state. So I have 7 states of my own organization providing that one policy. Where do I pay the tax? So this is the key challenge, and as I said, I don't want to get too technical, but this is the key challenge that service providers are looking at, including yourselves. When we come to a few slides, I'll talk about that. The other very, very important change that comes in with this law is that tax moves from provision of services or sale of goods to actually supply. Okay? And supply is a completely new term for Indian tax jurisdiction. It's a global term. This is the way tax applies globally as well. But from an Indian standpoint, supply is a new concept. Suffice to say that supply is so expansive that it can cover moving the remote from the right hand to the left hand. So that's supply. Okay, the supply could be of the widest import. Now, which means that if in my insurance example, I decided that Bangalore is the revenue booking location, so I provided the services from Bangalore, I definitely had underwriting support from Delhi. I had a head office support from Gurgaon. I had a policy issuance support from Mumbai, and therefore I have 3 other offices at least of my organization, and of course a foot soldier in Cochin. So 4 other offices that provided support to this Bangalore transaction. If I go by the word supply, the transactions between Bangalore and these 4 other offices will be regarded as taxable transactions. So bringing in the concept of supply means that any transaction between 2 offices of the same legal entity, albeit in different states, also becomes taxable. If we take a simpler example, if I go back to the telecom example, when you roam in Delhi, the tax on the entire roaming revenue has to be paid by Vodafone Mumbai because that's where your connection is and that's what your service provider location is. But Vodafone Delhi has supported Vodafone Mumbai for supporting that customer, and therefore Vodafone Delhi has to cross-charge Vodafone Mumbai, is the way the rule book reads right now, for that roaming support provided. So essentially all transactions within the same legal entity also get taxed. That, to my mind, is the most significant change that is coming in. In the interest of time, I mean, I like this slide because it says that India becomes very colorful for a service provider. Every state becomes its own jurisdiction. So that's what you're dealing with. I'm skipping the reporting requirement and jumping straight in the interest of time to what the asset management business is getting impacted by, and then we'll come back to some of this if required. So on the asset management side, if you look at our classical supply chain, we will obviously have an AMC, a mutual fund, both generally co-located within the same state, and therefore taxes will apply in that state. But you would have an office network across the country which will be supporting the entire sale, customer relationship management business. And you would also have a bunch of external service providers being distributors or R&T agents, lawyers, and the like. Now, when I start talking of each of these pieces, the first is that the transaction between the AMC and the fund, all the transactions happen within the same state generally, and therefore these transactions are taxable, let's say, in Maharashtra. But what if you are a sub-advisory entity to an advisor or to a fund outside India? What happens? Today, for all that income, you are not liable to tax. It is treated as an export supply. In the way the law is worded right now, those transactions become taxable. So that's a very, very big change. Of course, a lot of representation is already going in to say that this error needs to be corrected, but that's the way it reads today. That's one. When I look at my sales office and distribution office network, the distribution offices or sales offices are supporting sale of units and distribution of my products across the country, right? My revenue booking location typically is Mumbai because that's where I'm doing the entire fund management service. So from a cost incurrence standpoint, because every state is a different jurisdiction, I will start incurring local state level taxes in all these states. I will have a rental on which local taxes will be charged. I will have telecom on which local taxes will be charged. I will have travel, ACO, all the branch related costs. the tax credit will be in that state. That tax credit is today completely fungible at a central level for you. If you pay rental for any of your branches, you use that service tax, merge it with your total central pool today, and pay your service tax that you have to pay on the AMC income. No longer that is going to work. Tax credits are locked at state level. So in every state, you will have a tax credit, and they don't naturally merge into the central pool the way they merge today. So on the one hand, if this is the regulation, then you are likely to lose all tax credit that you are incurring outside the state of Maharashtra, if we are talking of a mutual fund based out of Mumbai. And that obviously is a cause for concern, not just for you, but for several service providers. The solution in the law is going back to the word supply. The word supply says pay tax on internal transactions as well. So basically, all your branches will essentially register as support services providers to the head office in Mumbai. They will cross-charge to the head office in Mumbai, pay tax, use the underlying credit, and bring the pool back to Mumbai. When you're doing cross-charges, the valuation code kicks in, and the valuation code suggests that it has to be a cost plus, which means that you will do cross-charges on values including salaries, something on which you are not receiving any input recoveries, but in the cost plus it will enter and you will start charging tax on those elements. If you look at the distribution side, today we have a forward charge that is thankfully come in from 1st April, and therefore a lot of distributors have become exempt. The limit is likely to be pushed to 25 lakhs. You would have read the reports. The 1%, there is also a scheme of smaller service providers above 10 lakhs paying 1% of the turnover up to 50 lakhs. That limit is likely to be pushed to 1 crore. There is a conversation. So pretty much all your non-corporate distributors can potentially become exempt. So that's a huge positive for the sector. The only thing which is already getting impacted without doubt, but will get even more obtuse in GST, is that aggregator distributor models will have to be dismantled in a sense. Because if you are aggregator distributor, you may bust the threshold. If the commission is inclusive of tax, then the net watershed to a guy operating through aggregator distributor will be very different from somebody operating directly. So those structures may undergo a change because of the way the law reads. In terms of the trust fees, trustee fees, they are liable. They'll continue to be liable. All other services that you have, which is R&T, etc., liable, continue to be liable. So in terms of what is taxable and what is not taxable, hardly anything going to change. In fact, nothing will change. That's a good assumption to make. What is only changing is that your pie is getting split across the country into multiple pockets, and you will have to balance all these pockets to figure out, on a net basis, how does it work. The other important thing that changes is all the incomes that you have from overseas advisory, those incomes currently become liable to tax. Hopefully, that point will get corrected, and that issue will get addressed. If I were to just come to the last 1 minute of the conversation and talk about what companies are doing to kind of embrace this change, there are 3 core processes of your business: P2P, O2C, R2R, procure to pay, order to cash, and record to report. Okay. On the P2P side, which is procure to pay, tax credits are now moving electronic. So you will get tax credits only electronically, much like 26AS. So your tax credits are dependent on your vendors' compliance levels. If the vendors are not compliant, you don't get tax credits. So how do you ensure that you have the right set of vendors and they are doing their compliances is going to be one of the biggest pieces of P2P transformation. For your business, because you have some larger vendors which eat up most of your cost, the challenge may be lesser, but for slightly bigger and more complex businesses, more widespread businesses rather than bigger, the challenges are far more complex. On the O2C, which is the order to cash, the way you charge taxes is going to change because you're now going to start mapping and measuring internal transactions. If credits are electronic, the Jaipur branch will also have to report sales of support services to Mumbai branch, which will become a purchase for Mumbai branch, and Mumbai branch or Mumbai head office will get a credit of that. This is something that you're not used to, right? So from an O2C side, the process is going to change substantially because you are now going to report internal transactions as taxable supplies. And on the R2R side, on the record to report side, it's very nice to just throw the statistics. Assuming that you have offices in at least 20 states, right? And today, when you file service tax returns, you file 2 tax returns a year. In GST, you are expected to file more than 1,500 tax returns a year. So, and it's all electronic. So from an R2R side, again, a very, very significant impact. What is your level of automation? What is your level of preparedness on the P2P O2C side? How correct is your information, because you're now going to report every single transaction on the government database, is going to be very, very important. So this is what I thought we could talk about from a mutual fund standpoint or distribution standpoint. Do we have 5 minutes for questions? I don't know. Okay, we have 2-3 minutes for questions.
So, good evening, sir. So, if most of the distributors go exempt, then there'll be no input credits for the AMCs, right?
Not on the distribution side, you're right.
Do you prefer larger distributors? That will
Not really, because see, one is that today a lot of distribution models are including tax. So the AMC, it doesn't matter to the AMC.
No, they are not including.
Correct. If it is not no, I'm saying including tax means if you get $100, 15 is deducted out of 100 and you get 85 as a distributor, right? Even if you don't have that model, and if the distributor gets 100, he pays 20 of tax because the GST rate is going to be higher, AMC will get full tax credit of that. The challenge is going to be in NFO kind of situations where your expenditure is far more than your revenues, and therefore you have inverted structures where you carry those credits for many, many months or sometimes years. So in those situations, they will be happier dealing with distributors who don't charge tax, so that credit accumulation reduces.
Second query, sir, if any organization has offices across states, will all have for the internal billing?
Yes. Yes. That is a mandatory provision.
And the value of the service will be internally decided?
Cost plus. So that's a big issue. I mean, it's not an issue. I love it because it gives me a lot of work. But they are bringing in the concept of transfer pricing in GST. And through industry representations, we've got back to them to say that our feedback is we don't need such complex rules for taxing internal transactions. It's a welcome thing to tax internal transactions because, like I said, otherwise you will lose credits in all the other states of just branch offices who is doing distribution. So it's good to have a mechanism to transfer credits from one office to the other, but it's not so good to have complex valuation rules around it because whatever is tax paid by Delhi will be tax credit by Mumbai. So that tax on an internal transaction is not a revenue of any of the states. So if it's not your revenue, why are you so paranoid about on what value did I pay the tax? So that's the point that the industry bodies have represented right now.
Sir, one more, sorry.
Yes.
There is incentivization to backward areas. Will not there be a back entry to that also once this will again become more and more complex?
In fact, GST as a model suggests that there will be no incentives to any backward areas. So now you can't give any tax linked benefits at all.
But don't you think there will be a backdoor entry to it in future?
Why would you say that?
incentives needs to be given for backward areas.
No, so let us look at this, and if you look at the economic theory around GST and why they are saying no exemptions, they are saying no exemptions so that the chain is not broken and seamlessly only the B2C segment or the business to consumer segment suffers tax, correct? Now, there is no incentive for any state to any longer give any VAT or sales tax or excise duty exemption. The reason because GST is a consumption based tax, so only the consuming state will get tax credit. So if you're not a consuming state and you're a manufacturing state, prima facie there's no benefit. The indirect benefit is that if you encourage manufacturing in your state, you will create consumption, because then people with more disposable income will come to your state, and only then your tax collections will go up. So the need, so the point that you make is valid, that the need to push industry to come to my state is only increasing, or to create better infrastructure is only increasing in GST, but the gestation is far longer and the benefits can be given only on a non-tax basis. You can't give tax-linked benefits.